Welcome back. Now we will discuss about module 2. What is module 2? Capital markets. In module 1 we saw what is banking. From now on we will start with capital markets and then keep going into various of the modules that we will be discussing. Capital markets, as always, the LinkedIn details, our website details, YouTube channel, Twitter ID, and to anybody interested in training programs, the contact details are given as you can see in the slide. Target audience, as always, the target audience is again the same set of target audience, any graduates, BA, BSc, BCom, or for that matter anyone attending any interview, particularly in the banking and financial services sector, house managers, and anyone interested in enhancing their knowledge. Takeaways. Before we go into the takeaways, one thing I want to tell you all here is that to understand banking and finance, all you require is two things. What are the two things? One is that simple English meaning. Hence, I request each one of you to have dictionary in front of you or have in front of Google, check the meanings whichever you are not comfortable with. That's number one. Number two is common sense. So, the more you see such videos, educational videos and develop knowledge, your common sense will also improve. So, hence these two things are sufficient to have a sound understanding of banking, finance, or for that matter any concept in the world. So, takeaways. Takeaways, investments. What is the need and expectations? Investments, four-dimensional view. Business entities and their salient features. Capital. What is the need for capital? Why we require capital? Then corporate actions. What is corporate actions? Mutual funds, a overview of mutual funds. With that we will end this module 2. Now let us go into investments. Why investments? As you can see, why investments? Many times I ask people, they give various reasons. Investments, as I have mentioned here, why? It is for future requirement, because future is uncertain. As we all know, at young age our health is good. As we grow old, our health also deteriorates. Hence we require more amount of money. We don't know how much we require. Second is inflation. Inflation is something very simple. Anyway, we will explain in detail later, but we will give a high level view over here. Too much of money chasing too few goods, that is called inflation. Or in simply, the price of commodities going up against rupee, that is called inflation. That means last year with 100 rupees, if you would have bought 1 kg of some item, in this year if you are able to buy the same 1 kg at 120 rupees, then that means the price of that commodity has gone up and rupee value has depreciated. That is called inflation. For these purposes, we require investments. Why? Expectations. What is the expectations? Regular returns. We want regular returns. If you have a fixed deposit with bank, you get interest. And capital appreciation. The capital that we put, many a times you would have heard people, I bought this house for 20 lakh rupees, now it is 50 lakh rupees. That is capital appreciation. So, we want the value of the asset to grow. So, that is the expectation of an investment, any investments. Four-dimensional view. So, many of you would have talked of all three dimensions, but nobody talks of the fourth dimension. Anyway, we will discuss about the fourth dimension. What is that? Liquidity. So, risk, returns, rewards or capital appreciation, that is what we call, and fourth dimension is liquidity. So, we will take all the asset classes and rate them on risk, returns, rewards and liquidity on these parameters. Cash. Is there a risk in cash? Absolutely no risk, excepting that the cash has to be safely stored, otherwise no, it can be stolen. Assuming that we are able to safely store in a bank locker or at our home itself, then there is no need for there is no risk in cash, no need to worry, because after all with cash you can buy anything and everything, and also there is no risk of losing that capital. Is there any return on cash? Absolutely no return. You keep 10,000 rupees in your cupboard last year in 2022 January 1 and January 30, December 30, 2022 you take that money, it will be same 10,000. But what happens? Is there a capital appreciation? No, actually capital depreciates. Why? Because earlier slide we saw inflation. Due to inflationary effect, the purchasing power of rupee goes down. Hence, For the same 10,000 rupees, what you would have bought in January 2022 or December 2021, you will not be able to buy the same item in 2022 December. So hence there is a negative appreciation if you purely keep it as cash. Liquidity. What is liquidity? Liquidity means the ability to convert into cash. How quickly one can convert into cash. That is called liquidity. Cash itself, because we want everything to be converted into cash, and hence cash is the most liquid. Of course, you will see that today in 2022, banking is the most liquid, more than cash I would say, but still cash is one of the most liquid items. You don't need to convert a cash into cash, already it is in cash. Next is gold. Is there any risk in gold? Yes, low to medium. Of course, storage risk is there. You have to safely store that gold somewhere, otherwise it also can be stolen. Is there any returns on gold? No, there are no gold returns on a physical gold. Okay, so there are no returns. What is the rewards? Rewards are medium, because what happened? You buy gold, let's say 2020 you bought some gold, today the value of gold has appreciated. If you sell it, you will get more money. So obviously there is a return, but the returns are medium, it is not high. Liquidity, medium to high, because if you have a physical gold, selling physical gold is not that easy. You have to go and approach a shop and then request them to buy, and you have to give your PAN number if you sell beyond a certain value. All those things are there, hence it is not liquid. Bank deposits, is there any risk? Absolutely low risk. I am not using the word no risk, low risk. There is a difference between no risk to low risk. Low risk, why? Because as we saw in banking module, Reserve Bank of India and government will ensure that no banks fail, and also there is a deposit insurance that is taken by banks. I think 5 lakhs, up to 5 lakhs there is an insurance that is available. Hence there is a low risk on any bank deposits. Our money will definitely come back. What is the returns? Returns, they give interest, periodical interest, savings or fixed deposit. Fixed deposits fetches you higher interest, but it is of lower interest. Hence, no, it will not be able to beat your inflation. That is why the capital appreciation is very little, because it cannot beat the inflation. Liquidity, it is the highest form of liquidity. Why? More than cash, I would say, because today beyond certain amount, we cannot do cash transactions. Everything has to be a banking transaction. So bank deposits, you convert, the moment you break the deposits, it is in your bank account. So hence, no, you can use it in whatever way you want. Hence, it is the highest liquidity that is one can think of in any asset class. Real assets, land and buildings. Risk, is there a risk in real assets? Yes, the risk is medium. I wouldn't say low, I wouldn't say high. Why medium? Because the capital appreciation might not be there. Returns in the form of rent. Wherever, if it is land, there is no returns. If it is building, yes, it will fetch you rent as returns. Capital appreciation, yes, it is medium. It is comparable to a gold, but it cannot be compared to that of equity or other asset classes. Liquidity is the lowest. Why liquidity is the lowest? Because if you have an asset in a prime property, let us say for example in Nariman Point or Kolaba in Mumbai, the hottest place in India, even there if you want to sell, it will go quickly, but you have to find a buyer. Buyer need to have funds, or the buyer has to arrange funds through bank loans. It will take some time. Hence, it is the least of liquid assets that one can think of. Also, sometimes why I given the risk as medium is, sometimes what happen in bank deposit, in real assets, many times we have seen people bought big flats in outskirts of the city with all amenities and other things. What has happened? When they want to sell, they are not in a position to sell. If they want to give it for rent, nobody is there to come for rent. On top of it, the maintenance charge by the society, they have to pay for it. Hence, no, it becomes a liability than an asset. Hence, real assets cannot be classified as a low risk. It is medium risk, and liquidity, it is the lowest without any doubt. Next is equities. Equity shares. What is equity shares? We will discuss in detail later. At this point in time, you might be having a understanding of shares. So, shares, a portion of the ownership of a company, that is called shares. Okay. Shares, the risk is high. Why the risk is high? Many times we have seen the companies, we invest money in a company and the company has to perform and the company share price has to go up. If the company itself closes, then the risk of losing the entire capital is there. Hence, the risk is high. Returns in the form of dividends. Companies pay you periodical dividends. So, that is returns. Capital appreciation, the share price goes up. If a good company is there, many times you have seen, no, many companies in India, there are great companies that we have created in India, and we can think of many examples overseas also, like for example, Bank of America, Amazon, Apple, all those companies are there, where over a period of time they have created wealth. Hence, investing in those companies, the capital appreciation is going to be great. Hence, the capital appreciation is the highest in equity investments. Liquidity is high next to bank deposits. Why? Many people think that, oh, shares, no, I cannot sell. No, shares you can sell easily. Anyway, when we see in the subsequent modules, we will be discussing about the settlement cycle and other things, where you will be easily able to understand the liquidity, concept of liquidity, and how easily one can buy or sell shares in India, or for that matter anywhere in the globe. But India is, I would say, way ahead than most of the countries in financial markets. Corporate debt. What is corporate debt? Many times companies borrow instead of and people invest in the corporate debts. In the companies borrow in the form of debt, debenture or bonds. In India it is called debentures. So, people invest money in that debts. So, what it means? It means it is a company will repay the capital and also will pay a fixed interest, which is known upfront. So, the returns are, risk is medium to high. Obviously, the same company we are giving it as a loan instead of being part of the ownership. Hence, there is a risk. The risk is medium to high. Why it is not high? In the case of winding up of a company, first the bondholders, their liabilities have to be made by the company before giving anything to the shareholders. Hence, they get preference, which is why it is medium to high. Returns in the form of interest that the company pays, and rewards is very low, I would say, or even medium, because the interest probably will beat inflation, but it is not good enough for us to get a good return as compared to that of an equity. Liquidity low to medium, because what happened, normally a debenture or a bond will have a lock-in period. Basically, the company will say, I am issuing a bond for 5 years or 7 years, and you have to invest minimum capital of 1 lakh rupees or 2 lakh. I am giving an example, 1 lakh or 2 lakh or 10 lakhs, whatever the case may be, and the bond is for 5 years and interest will be paid at 6% or 7% or 8%, whatever may be the interest every year, payable annually or semi-annually as per the terms. So, they will upfront state what is the terms of the bonds, and the bond will mature only after the expiry of the time. So, once it matures, then only you will get the money. Hence, there is a lock-in. Hence, there is no liquidity. What is liquidity? I wanted to sell, I have to sell and convert into cash. I cannot do that. I have to wait. Next is government securities. Government securities, there are many things. I am just giving few examples like post office, government bonds, RBI bonds, and PPF, to name a few. Risk almost zero. Why almost zero? If you see in banking, in the earlier slide, we told that the risk is low for a bank, but for government it is almost zero. Why almost zero? Because government cannot default. If you don't trust government, then whom you will trust? So, government bonds or government securities are absolutely safe, near zero. Hence, the risk is near zero, almost zero. Returns are low, very low returns. Government securities, you take a deposit with post office, MIS or any government deposits, the rate of returns are low, excepting and rewards also obviously low, excepting PPF, Public Provident Fund, where it gives a very high rate of returns, and also it is tax exempt. Of course, with last budget there are certain beyond certain limits might be taxable, that is for PF, but for PPF there is a limitation in the amount of contribution one can do without any restrictions. Of course, the limit is there. Every year we can put that much of amount. I think 1.5 lakhs is the amount. So the returns are high. Also, in income tax we call it as exempt. So hence it is having that benefit also for income tax payers. So it's a fantastic instrument. Liquidity is low, because even in a PPF the lock-in is for 15 years. Of course, you can take a loan against that PPF, but still there is a lock-in, and hence liquidity is low in PPF and also in all the government securities. Next is mutual fund. Of course, we will explain what is mutual fund later, but with the basic knowledge that you have or a little knowledge that you might have at this point in time, we will discuss. Mutual fund is a pool investment vehicle that pools funds and invests in equity markets or debt markets, or simply in capital markets or stock markets. So the risk is medium to high. Why? Because if you directly put in equity, you saw the risk is high, but a mutual fund, a fund manager will pool all the funds and invest in various companies. So they might invest in IT sector, they might invest in banking sector, they would have distributed the risk. Hence the risk is medium to high. It is not high as against that of shares, because they are not going to invest in one company, they will invest in multiple sectors, multiple companies. Returns. Mutual fund also gives dividends. The dividends are payable at periodical times. They will declare dividends. Returns, capital appreciation, it is medium. Why medium? If you see in the equity, we have said the risk is high, rewards is highest. Here it is medium to high, rewards is medium. Why? Because they distribute, the risk is distributed, hence the reward is also distributed. Okay. Liquidity, it is high. Why high we will see later, but when we talk of open-ended fund and closed-ended fund, mutual fund, in a open-ended fund you can just sell it to the fund at the NAV price any day, any working day, when I say any day. So hence liquidity is high, and in a closed fund it is listed in a stock exchange. So you can have exit easily. So this is a very important four-dimensional view, which I would request each one of you to go through thoroughly and have a deep understanding of it. Of course, you might agree not to agree with me on certain items as high or medium or low, that's individual perception, but overall conceptually this is what it is. Now let us look at the business entities and their salient features. First, let us start with sole proprietorship. As you can see in the slide, I have put sole proprietorship, partnership, private limited company and public limited company. So I will toggle between slide 7 and slide 8, okay, as and when I discuss. Sole proprietorship. What is sole proprietorship? It's a sole business. Many times you would have seen a small shop run by one man. Probably his family members will be supporting him. So what is the feature of it? The capital available is very limited, because it is one person's capital. Knowledge available is limited, because whatever knowledge he has, only that much is available, and hence the risk taking ability is also limited. Of course, the profit and loss is fully enjoyed by him. Any profit he takes, any loss also he takes. We go to next slide. Hence, because of this reason, his personal assets are combined. Suppose if his business is in a loss, the people who are given loan or who are to take, to whom he has to repay money in the normal course of business, they can have right to take his personal property also. Hence, his personal assets are combined. The business continuity, is the business continuing? No, the business stops the moment he dies or if he becomes insane or lunatic. Okay, and closure of business, any time he can close, either death or he decides to close tomorrow, fine, he will close the business and go away. Governance, is there any governance? No, whatever rules he says, that is the rules. So there is no governance mechanism. Next, we go back again to slide 7, where the ownership, partnership. In partnership, it is an extension of sole proprietorship. Only thing is that multiple people coming together and commencing a business. So obviously two persons are required minimum. I think in the partnership deed, they have to sign a partnership deed amongst all the partners, and then they have to commence the business. What is the capital? The capital is again limited more than an individual. Why? Because one person, how much he can contribute? If there are 2 or more people, they can contribute more. And risk taking ability, because of it, the risk taking ability is also more. And obviously experience and knowledge, more people come with the different types of experience. Probably somebody can be good in marketing, somebody can be good in administration. They all can combine their knowledge together and run the business efficiently. Profit and losses are shared equally or as per the agreement in the partnership deed that they have entered in. Personal assets, here also their personal assets are not safe. It is combined. That means in case of loss, their personal assets will be attached. Business continuity, the business cannot continue. Why? If let us say out of 10 partners are running a business, one partner dies, what will happen? The successor, if he or she wants to become a partner along with the existing 9 partners, the existing partnership deed has to be closed and new partnership has to be entered. Hence, the business cannot be continued. It ends with the end of a person, or any one person cannot operate as a partner. Closure of business, the same, any time, or death or mutual consent. Governance, there is a governance in the partnership deed, whatever they have put, that is a governance. Next is private limited company and last is public limited. There is not much of a difference between these two, excepting that in a private limited it is closely held, in a public limited it is held by many people, general public. There is in a private limited company, what is company? Company, they say, is an artificial person. It is an artificial person created by law, having a separate legal existence distinct from that of his members, with a perpetual succession. This definition is very important. A company is an artificial person. That means a company is created by law, an artificial person. A company is an artificial person created by law, having a separate legal existence. It has its own legal identity, different, distinct from that of its members, or who are all the promoters or who are the shareholders. It can sue on its own name and it can be sued on its own name. So, anyone can file a case against a company, likewise the company can file a case against any individual. A company has a perpetual succession. What is perpetual succession? It is a going concern, it is there forever. Men, women will come and go, that is we are born, we will die, because we are natural person, but an artificial person will keep going till the business is closed by the operation of law. That is what is a company. Private limited company, where the ownership is restricted and they cannot invite the general public to become shareholders. Public limited is company, anybody and any public, general public can become a shareholder. That is the only difference. Of course, there is a minimum membership for both public limited and private limited. Maximum is there for a private, I think it is 50 now. The numbers are more of academic, you can check, because these are all operational and time to time it might change. So, I think it is 50. In a public limited, there is no restriction on the number of members. Obviously, as you can see, there is a wider capital available in the case of private limited. In the case of public limited, unlimited capital. Of course, there is the word unlimited itself is not correct, but technically there is unlimited capital available, because anybody from India can become a shareholder, and so much of money is available to the company, public limited company. Risk taking ability relatively higher for a private limited company. Public limited, it's superb, because they can hire the best of the managers, they can take any kind of risk that they want, and they have the adequate capital also. Knowledge and experience, again same, they can hire anyone whom they want. Hence, company can attract the best of the talents, both private limited and public limited. And public limited, because of the funds available, they have wider pool of resources that they can tap in. Profits and loss, it is proportional to the share capital, both. Personal assets are not combined. There is a corporate wheel. A company is an artificial person created by law, having a separate legal existence distinct or different from that of its members. There is a corporate wheel that exists between the members and the company. So, if I run a company, Prabhu is different, and my company, I might act as a managing director of my company, the company is different. Hence, there is a different identity, there is a corporate wheel that exists. Perpetual succession, as I told you, because the business cannot be, if let us say we saw the example, right? In an individual or partnership, if a partner, in the partnership you take, one partner dies, the business will come to an end. In the case of company, what happened? The successor becomes the shareholder and the company is run. So, the company cannot be put an end by the death of one partner or by one shareholder or even by all the shareholders. Assuming there are 20 shareholders in a company, they are flying from place A to place B. Assuming that some untoward incident happened, all of them die. Will the company come to an end? No. The successors, the sons and daughters will become shareholders and the company will run because it is perpetual succession, different from that of its members. It is applicable for both private and public limited company. How it can be closed then? By operation of law. Why? Because it is an artificial person created by law, hence it can be closed only by operation of law. And governance is Companies Act. So, both are governed by the Companies Act. I am sure that if you have developed a good understanding of this, it will be really helpful for you to understand deep into the further concepts that we will be discussing. Next, capital, needs and types. Why do we require capital? From now on, we will be talking of only about companies. We are not going to talk of individual or partnership. We are going to talk only of private, public limited company, excepting one case where we will talk of how a public limited will be converted into a private limited will be converted into a public limited company. Otherwise, when we talk, we are talking only from a company perspective. Capital, equity. Why capital is required? Because company wants to invest. They want to invest in R&D, they want to set up a plant, they want to expand their business, hence they require capital. So, capital, as we know, is a scarce commodity, hence they have to approach the public to get capital. The capital can be available in two ways. One is the equity capital, which is the owner's capital. We saw they are the shareholders. The other way the capital that can come is borrowed funds. They can borrow in the form of debentures or bonds. So, that is called borrowed funds. So, borrowed funds, where we will see the difference when we go into the next slide. So, these are the two ways. Of course, third way is there, the loan from banks and other entities that the company can take, but we are largely talking of these two ways in which a company can get capital. What is, let us go into the next slide, capital types. Category, equity capital and debt capital. Ownership type. So, what happened in the case of equity share, a shareholder, a person puts some money, minimum shares that he takes and becomes a shareholder of the company. By virtue of becoming a shareholder of the company, he has the right to be part of the management and he runs the business. He has the right to run the business. Whereas in the case of a debt or debenture in India it is called, or bonds it is called globally, where he gives the money as loan. Because he gives the money as loan to the company has to repay the money at the end of the time period. Also, the company has to pay periodical interest. These are stated upfront at the time of issuing of the debentures or bonds by the companies. So, yes, shareholder ownership is a owner's capital, hence they are called owners. Whereas a debenture holder is called they are creditors, they are given loan to the company, hence they are debenture or bond holders. Funds, it is called owner's funds, whereas debt capital is borrowed fund. Returns, company gives dividends to shareholders, whereas it gives interest to the bond holders. Capital, how the money is returned back. In the case of equity shares, it is returned. The company will not give the money back to the shareholder. It will be through the capital market process, secondary market process, and also through corporate actions, which we will see down the line. In the case of debt capital, it will be through redemption. So, as I stated earlier, company would have stated that I am issuing a capital, I am issuing a bond, 5 years bond, the bond matures after 5 years. That means the company will repay that capital at the end of 5 years. That is called maturity or redemption. That is what it is called. Rate of returns, in the case of equity, the rate of returns are not fixed. Why? Because after repaying everyone, the balance available is available to the shareholders. So, hence the rate, if there is no profit available, they will not get anything. Whereas, whether a company makes profit or loss, the rate of interest that they have told at the beginning of issuing of the bond, that they have to pay to the bond holders. Hence, it is fixed and known upfront. Capital appreciation, it is high in equity, In the case of bonds, it is restricted because they will get only the interest that is agreed upon. Loss limited to the ownership. So, whatever capital that they contributed in the case of equity, debt capital, they are not liable to take any loss because they are not part of the business. Life of the asset, equity life is perpetual. That means till the company is there, the equity shares will be there. Whereas the bond life is fixed because the company will say 5 years or 7 years. That means the life of the bond is only for 5 or 7 years. Management, as I said, the shareholders have the right to manage, whereas debt holders, they don't have the right to manage. Voting rights, because of which shareholders have the voting rights, whereas the bond holders does not have any voting rights. They are eligible, equity shareholders are eligible for other benefits, which we will see later on, rights, bonus, which bondholders are not eligible. Winding up, equity shareholders don't get any preference, whereas bondholders will get first preference. This is the difference between a equity capital and a bond capital or a debt capital, debenture capital, and the benefits. Corporate action. Next we will see corporate action. What is corporate actions? Any event that is happening in the corporate world, that we call it as corporate actions. What are the various types of corporate actions? I have categorized as monetary and non-monetary. What is monetary? That involves money. Non-monetary means it does not involve any money. Monetary, we will see dividend. As we saw, company will give dividend out of the profits that are available after repaying everyone. So, that is dividend, that is monetary. Interest, this is paid to the bondholders. Redemption, the capital that is returned back to the bondholders is called redemption process. It is money involved. Before we come to that rights, we will go to proxy and bonus. We will see bonus, proxy, then we will come to rights. Bonus we will see, then we will come to rights. Bonus, what is bonus? We all know bonus. Everybody working in a company will ask for bonus. Bonus means additional. So, company giving additional shares without any cost, that is zero cost, is called bonus. On the contrary, rights, I have put it as monetary. Why? Because company will issue additional shares to the existing shareholders at a discounted price. Let us say, for example, a company is quoting at 100 rupees in the market. The company will decide that I am going to issue additional shares 1:5. That means 1 share for every 5 held. Let us say, for example, that means if somebody is holding 100 shares, they will be given 20 more shares. So, the shareholder will be given the choice to subscribe at, let us say, 25 rupees, because as an incentive to my existing shareholders, the company decides to issue at 25 rupees, whereas the market price is 100. So, the shareholder has the right to either subscribe or not to subscribe. That is why it is called rights. In the case of bonus, their account, demat account, will automatically be credited. They will be given the additional shares without any cost. Proxy, many of us would have done in colleges, where on behalf of someone, in the case of in corporate actions here, attending a AGM on behalf of a shareholder is called proxy. The proxy will act on behalf of the shareholders. That's all. So, please develop a good understanding of corporate action. This is very important. Now, let us look at mutual fund. What is mutual fund? Mutual fund, it is an investment vehicle that pools resources, that is money, from various individual investors and then invest in various capital market instruments or investments like equity, debt, or wherever they feel as per their mutual fund scheme or policy that they have announced. So, that is called mutual fund. So, what are the types of mutual funds? There are open-ended fund and closed-ended fund. So, open-ended fund, name itself, as I told you, to understand banking and finance, you require simple English meaning, common sense. Open-ended means it is open-ended, it is perpetual. That means today I can be an investor in a mutual fund. I might not like to continue, or I want to exit for some reasons. I can approach the mutual fund and sell the units at the net asset value or NAV. So, on any day, every day, mutual fund announces its net asset value of every scheme. Mutual fund comes out with various schemes. So, if I am part of scheme 1, I cannot go and ask the NAV of scheme 2, because the NAV scheme 2 will be investing in various asset classes. Okay. So, that is called open ended fund. In the case of closed ended fund, it is like a stock where it is listed in a stock exchange. So, I can sell it in the stock exchange and I can exit anytime. So, that is type of funds. Classification, further classification on equity fund, debt fund and balance fund. What is equity fund? A mutual fund which only invests in equity capital, equity, that is, it invests only in shares, that is called equity fund. Debt fund is something where it invests only in debt, in bonds and debentures of companies or bonds and debentures of government securities, because as I told you, it is relatively safe, but returns are not in good as compared to that of an equity fund. Balanced fund, basically it is a simple balance, part of it in equity and part of it in debt, that is called balanced fund. Then there is something called fund of funds. What is fund of funds? This fund will not invest in directly in equity or debt or anywhere, instead it will invest in other mutual funds, hence it is called as fund of funds. Finally, a view of asset allocation in India, somewhere it was taken out from some source. As you can see here, 77% in India like to invest in real assets, while the financial assets are only 5%. Hence, think of it, if these assets, if more Indians were to invest in financial assets, then you can see how well our financial markets will perform. Thank you very much.